It's been a fascinating start to the year. After a really positive 2017 and in fact a great start to 2018, it seemed like it was too good to be true, and I'm afraid to say it did prove to be that. And the first 2 weeks of Feb 18 saw bond markets, equity markets and various other asset classes take a reasonably significant hit. But before getting too excited about it, it's worth pointing out that most markets are in fact back where they were sort of December 2017, so we're really not too far off previous all-time highs that we were making back in January. What is notable is quite how sharp and quick the sell-off that we did see over a few days in February was, and it's understandable that investors were rattled by it. So what has changed that caused this upset in markets? Well, as we see it, markets were underpinned by two broad themes in 2017 and at the beginning of 18. So the first of those themes is the idea of the Goldilocks economy, the idea that the economy has been running not too hot, not too cold. The general gist of economic data has been positive, but not so positive that inflation has got out of hand to the extent whereby it would upset bond markets or equity markets. The second theme is that central bankers are a steady hand on the tiller, and that they're still happy to keep monetary policy broadly loose as it has been for many years. So both of these themes came into question with the jobs data that we had at the start of February that showed US wage inflation had picked up to 2.9%. Now, 2.9% may not seem extreme, but when you put that in context and say that's the highest that US wage inflation has been since 2009, it's understandable that markets started to question those two themes. Firstly, that inflation isn't running ahead of itself, and secondly, that monetary policy is going to remain at sort of historically loose levels for many quarters to come. So what are the opportunities in current, more volatile markets? I would say that volatility is a good thing, specifically for active investors. At the time, it may not seem so because markets are moving around lots, and you'll see some sort of fantastical headlines. But in fact, as active investors, our role is to look for an efficiency in markets. And when markets are moving around, sloshing between fear and greed, then that's when you do get these inefficiencies in prices. And just at our own level within UK equities, we're definitely seeing more opportunities now than we did sort of mid-January when markets were running ahead of themselves. So we thought it'd be interesting to leave you with the thoughts of Warren Buffett, where he said, we should be fearful when others are greedy and greedy when others are fearful.